Welcome. I'm Benjamin Bry, Kevin Bakes Baker, and Charlie Peabody. We're talking about housing today. We're talking about a couple charts with our chart guy, Bakes. You want to lead us off?
I thought I
Charlie
would
can
just
lead us off.
set the table and Bakes, when you want to add a chart, just interrupt me. All right. So but the reason I wanted to talk about housing, it's been a major theme here on Wall Street Beat since September. We've been suggesting that the home builders were rolling over and were short. And housing has a multiplier effect on the economy. It's a very important sector to watch if you're trying to understand where the economy is going. And I think Ben and I share a fundamental view that things are going to weaken going into the spring, summer. So you really do want to watch housing. And we're fortunate that there's a lot of data that came out between yesterday, today, and this coming week. And then so I wanted to review some of that data just to give us a sense of where we are in this housing rollover, if you will, or move. Jen, if you can put up the first chart. Yesterday, we had the National Association of Home Builder Sentiment Index, and it came in at 42, down 5 points. That's the lowest we've seen since December of 20. But you can see over the last couple of years, it's been in a pretty tight range. But what I want to point out is the 42 index is the lowest we've seen as the index has rolled, as opposed to when it's been rising. It's the lowest we've seen since June of 2006. And that's June 2006 was when I started, along with the big short guys, to recognize that housing was in trouble. It took almost a year before it really fell apart. And that's where I think we are. It's going to take a year for housing to really fall apart. But what we may be doing is moving from a situation where affordability problems are driving housing south to the next leg where unemployment rising will drive housing south. Jen, if we can go to the next. So these are some just bullet point observations. So the overall index of the stay there. The overall index fell 5 points to 42. We just talked about that. And the reason the sentiment soured amongst home builders is there's greater policy uncertainty, particularly around tariffs. And cost factors have created a reset for 25 expectations amongst home builders. Specifically with respect to tariffs, the home builders have noted that 32% of appliances and 20% of softwood lumber comes from international trade. And then there's also gypsum and cement that comes from Mexico, but they didn't give a number for that. But these are things that are going to affect the cost of building a home, and that's going to impinge on margins. The next observation that I thought was interesting in the NAHB yesterday was that the incentives as a use to get homes sold may weaken as a sales strategy because of the elevated rates. And so they're saying that the poor affordability has reduced the pool of eligible home buyers. It was interesting because 26% of home builders cut home prices in February, but that was down from 30% in January, saying incentives, therefore, are not being used as aggressively. The average price reduction was only 5% in February, unchanged month over month. And the use of sales incentives was only 59% in February, down from 61% in January. So what the home builders are basically trying to do here is hold on to their gross margins with fewer price cuts and incentives. But that may be at the expense of unit volume sales. And that's very important. And we saw that in the survey because they said the current sales index fell 4 points to 46. The future sales expectations, which is over the next 6 months, fell 13 points to 46. So it's now in decline. Anything above 50 was expansion. Now it's in decline. And then the index charting traffic of prospective buyers fell 3 points to 29. What they're giving up on incentives and price cuts to induce people to buy, that probably means that unit volume sales expectations are too high. And that's the last point here, is that current expectations are for unit sales to rise anywhere from 2 to 5%, depending on how bullish you are. And I think there's a good chance that if they give up on incentives and price cuts, we're going to see unit sales fall. If we can go to the next chart, Jen, this red line is the single family starts, but the blue line is the home builder market index. And the blue line tends to lead single family starts. And so you can see that blue line is turning down already, whereas starts had not turned down as aggressively. But I think you're going to see starts turning down. And so if we go to the next chart of housing starts, you'll see today's number came in light relative to expected. Housing starts fell 9.8% month over month to a 1.366 million rate. And that was below consensus. And that you in that total starts, you have multifamily and you have single family. Single family housing starts in January were down 8.4% year over year. And the reason that starts are down is because you have too much inventory. And you have too much inventory because we have a affordability problem right now. So Jen, if you can go to the next chart, we also this morning we got the mortgage purchase application index, and that this is for applications, purchase applications, and that fell 6.6% this week, and it erased the rise of the previous 2 weeks. It was also the sharpest drop year to date in mortgage purchase applications. And what's interesting is that decline in mortgage applications took place despite a drop in interest rates. So the benchmark interest rates for mortgages did come down. And so it's suggesting that high home prices remain a problem. So affordability is still a problem. And we go to the next chart, Jen. This shows you that affordability is at a 30-year low. And so we're not going to see the expected pickup in home sales that many of these home builders like Toll last night are expecting in the second half of this year. Toll disappointed last night on deliveries, on orders, but they didn't lower their full year guidance, even though they lowered their next quarter guidance. So they have this hockey stick type of formation in terms of their expected recovery. Jen, if we can go to the next chart. So this was showing existing home sales, and then in the salmon colored columns are new home sales. And we saw existing home sales are going to be reported later this week. And I'm expecting a disappointment relative to expectations of 4,090,000 existing home sales. And then I think the new home sales are going to be disappointing because if you go all the way over to the right, you can see that inventory for new homes still is rising in absolute units. And as a 8.5 month supply is above the norm of 6 months. So that's why starts are coming down. And think about it, starts are the future lifeblood of home builders. If starts are coming down, then they have fewer homes to sell. The data continues to roll is where I'm going with all of this stuff. We have existing home sales this Friday, and then we have new home sales next week. And I expect both of those numbers to be disappointing. Jen, if you can go to the next chart, this just is some listings of where you're getting price cuts. Texas and Florida are considered some of the weakest markets, but we've seen places like Denver, Nashville, Charlotte, Richmond showing price weakness as well. And this price weakness is a function of inventory. So if you can go to the next chart, Jen, you can see that inventory, for sale inventory is building in many of the metropolitan areas around the country. So let me just end up, because I've talked too long, with two last charts. So Jen, if you can go to the next chart. This just shows the listings in the DC, Virginia area where Doge is having an impact on employment. And as I said, I think over the next 12 months, we're going to transition from where affordability is creating a problem in home sales, in housing, to where unemployment may be creating a problem. There's something like 5,186 homes, according to Zillow, for sale now in the DC, Virginia area. And that's going to impact pricing. And it's going to impact employment and therefore CRE or commercial real estate. And so if you go to the last chart, Jen, what you're going to see is an office REIT called Piedmont. And you can see the marketplace has already been anticipating employment is going to be a problem, and therefore vacancies in offices are going to grow. And Piedmont has a big exposure to that area. So,
Yeah.
we've talked. Sorry, let me just finish. We talked to Horton, Lennar, Pulte Homes, PHM, Toll Brothers, TOL. But Ben's favorite, and he was early on in identifying this, was NBR, which is really dependent upon mid-Atlantic area such as DC, Virginia, for home sales. So NBR is a name that maybe Kevin can speak to or Ben can speak to. So I'll hand it over to you guys.
Yeah, it's funny, this PDM. I'm so mad because I don't know if everyone who knows and know or not, but like I had the election nailed into it and the reaction, and I had shorted Booz Allen Hamilton, and then I was telling people, I was like, you know what, DC real estate's a short, and I was lazy and I didn't find this thing. Oh, was that a good one? Bakes, what do you think about that, buddy?
Yeah, the tough thing with these is that you have yields, and so you've got your cost to borrow, and then you have the coupon that you have to contend with as well. But this, especially right here, this is the 50-day cross and the 200. If you want to be, dramatic, you can call it a death cross. But it's just these things are rolling over. And oh, by the way, apparently, because the government is such a good payer, good tenant, they're 1-year leases. It isn't 5 to 10. It's every 12 months you can go to zero in terms of your rent payment. If I owned a USAID building right now, I'd be nervous. I don't know, maybe if Piedmont does, but I don't like these things. The coupon bothers me, but dividends get cut. So this is rolling over badly.
Indeed. And Charlie, and congratulations, Charlie. That was a fantastic call. You've been on this for a while, the home builder call.
Big time.
Kudos to you, buddy. And the question is, as I was talking to one of my guys who's pretty good housing analyst for a long time and knows the home building stocks, is that XHB is sitting at one of the trend lines and it feels like it's about to break down. It's down 2% this morning. Do you think, because Charlie, I know you had expressed some concern about, oh, maybe they'll short squeeze me. But you think that maybe that's just is what it is, and we're going to go next leg now? You're on mute, buddy. Charlie, you're on mute.
Sorry. Yeah, you always get these violent bear market rallies, and these home builders are off quite substantially. They're coming down to lows that have been support in the past. And so I have taken in some of my shorts. I admit I've taken in a lot of my shorts, but I'm not finished with the secular theme. And what I was concerned about, Ben, was you've had a good rate call that maybe we get some weakness here in the economy and rates come down and you're heading into the spring selling season, which also can be a fairly healthy period. And that's what all these home builders are expecting, is that the spring selling season and lower rates are going to help them. But this is where, the tricky part comes in. Is the lower rates a function of a weakening economy, and therefore unemployment, starts rising and people feel, more shaky about their future. So you may not get that pickup in the spring selling season. It's a hard one, Ben. But that's what I was fearful of.
Yeah, and look, here's the thing. I don't know if it's easy, but I'm pretty good at identifying turning points, both on the bottom and the top. But when you run the trade, that's where you really get paid, right? Like it gets choppy, there's short covering, and you get shooken out on the long side and the short side. And the really good trades is you just have, honestly, sometimes it's better just not look at the screen, right? You did your work, you have a view, and the screen just is Wall Street's trying to get you to trade, trying to get you to move around, and it's hard. But I guess when we think about it, construction jobs are really weak. It seems as though the housing's rolling over, and now the government might be cutting a decent amount of jobs. So at least in that area and maybe nationally, Austin, Denver, Miami are pretty weak. And so outside of LA, where I am, that's unfortunately because of the tragedy, there'll be some home building activity out here. But yeah, I think that it's time for caution just in general, especially given the run that the home builders have had and just where the assets sit in general. Because Charlie, you had that point that's right, is that housing's a high multiplier industry. And so my kind of thesis is when I look at this government or this administration, they see that we have a lot of inflation. They see that we have a problem with the bonds. So if we go status quo, eventually the bond market's going to blow up, which is what kind of Charlie's been alluding to. And so it's just from a game theory perspective, it's better to cut all these jobs and get the recession's the good scenario. I think that's what people don't understand in my mind, is like the good outcome is a recession. And that's very different than in the past. If we go status quo and the bond market blows up, that can be systemic. Charlie, like that Bank of America, what are they sitting on? Like $100 billion mark-to-market loss?
$112 billion of unrealized losses, yeah. And that stock has earned its money center brethren because of that. And the Buffett selling as well. But go ahead.
Yeah, and what's interesting, because last night I was filming podcasts with our buddy David Dredge out of Singapore, and we were talking about Japanese banks, And I don't know if you saw it, but last night, Norchunkin's CEO is no longer. And those Japanese banks just announced a bunch of huge losses, a few insurance companies, because the 10-year there is up to 1.4. And it looks like it's just on a one-way train to 2. So they're replaying what we went through and what Europe went through. I don't know, what is that, a couple of years ago now? Like 22, essentially, 22, 23. And it's just an interesting dynamic where you had a world that like issued way too much debt in 2020 and 2021, and the bills being paid. And what's the way to offset that? It's lower economic activity. You got anything else on the housing thing, Charlie?
No, the value of Wall Street Beats is the diversity of people we have on this platform. And we have a wonderful technician in Bakes, Kevin, and he keeps us honest. He makes really great calls. So I'm curious what he has to say about the home builders or anything else about these financials.
I appreciate the kind words, and I think we have to leave our X feed, but just wanted to have you go to Wall Street Beat, sign up for a free trial. I hope you've seen that it's worth a while, and we'll see you real soon in the member chat. But let's go to the charts, as they say, and this is the XHB, but they all look like this. But here's NVR, and it's uncanny how many times I see something that we've talked about previously. It hits some trigger points, and then it ends up being fortified by the fundamentals. And I've got a sell discipline. I won't go through it all here. It works. It isn't perfect, but it works. And it keeps you from losing a lot of money on the downside here. But here's NVR. And percent of their revenues is in the greater DC area. And this is what probably the election day is, my guess. No, it took a while. This is Doge coming home to roost, and I would be out of this name if I owned it. Now, you talk about a short that's long in the tooth. I'll give you that. You go from a peak of 99.64 to 7,000. Okay, so let's look for bounces. And I think you're going to see a bounce here to 82.11. Now, let's not be crazy. It could be 82. It could be 81.50. I think it's going to be far less than that because all these people up here that bought with the promise of housing going up forever from 8,200 to 9,900 are now underwater big time. And so every time you see these feeble rallies, okay, you see how the blue, the up volume is anemic. And then you see the opposite of the down days where the volume picks up. There are a lot of frustrated longs that are saying, get me out of this. So if you see anything around 8,200, anything with an 8 in front of it, I think it's short heaven. That's my personal view. So I got some other thoughts, but I just want to give some air and see what you think about that.
It's been a great call by Ben. NVR was he got on early, and he's right about the Doge effect on the DC Virginia area. But yeah, that's what my concern is, Bakes, is we're at levels where you could get a bounce, and these bear market bounces are violent. But I don't think the secular trend down is over with. To me, bounces are to be shorted. Sorry.
Yeah, and I will watch the volume picture because I think these are going to be dead cats, which means lower volume and lower momentum. But I think if you see anything, let's call it 7,800 to 8,200, that's a gift from the short gods. Now, the other thing I wanted to mention is this is buttressed by all kinds of different things on the Doge front. Ben, give him some more flowers. This is Booz Allen. This is a part of the DC economy that clearly thinks that its top line is going to be hampered. And I'll just pull up one defense contractor. Look at the new low here the other day on Northrop Grumman. And they all look like this, by the way. Lockheed Martin, they all hit new lows on big volume like this. So you've got defense that's bad. The banks are looking bad. Your PDM is looking bad, the office REIT. So it's a home builder. It might be the best home builder in a bad neighborhood, but it's still a lousy neighborhood. And it's in a vice between being a home builder and being a Doge home builder. And that's a bad place to be.
Yeah, I sold a house in Mystic, Connecticut last fall. Mystic is right next to Groton. Groton has electric boat. It has a submarine base. Also nearby is Sikorsky, General Dynamics. all of that. So I was talking to the real estate agent yesterday, and she's saying they are very worried about, what's going to happen to the home environment in and around that area. So you're going to get these pockets of weakness. It's not going to be like 2008 where it was national. It's going to be fairly significant, I think, the weakness in housing.
I'd like to go to City next, if you don't mind. And we've been talking about this, and Charlie has done some great work here on the fundamental side. I'm going to go from the technical side. This is 8311, which is the prior high here back in pre-COVID. Here's the 8290. And it's amazing how these levels get respected over and over again. But come on, baby. We have finally, fine, I do whatever. The market does what it's going to do. What am I doing here? All right, we have taken out 8311, closed above it. This is the monthly, okay? So this doesn't have the whole month in there on bigger volume. And my point here is these are great financial crisis levels here at 120. And I like to be, I hope, helpful with my value-oriented brethren to have them hold their winners longer than they might otherwise. I think Charlie's mentioned 100. If you put the current multiple on his 760 number in 2025, you get to 103. This is 120 and 140, and there's very little resistance between now and then. And I know that sounds extreme. I know Buffett's selling. I couldn't care less. But we don't have the Mexico IPO positive news until next year. That is just starting to ripple through the system. We don't have the major Wall Street firms. Charlie broke this first by going into the bowels of the Mexican bank website. I don't know where he found it, but my point is let your winners run, especially when you see this breakout here, which is even more impressive I'll show you on the daily. Okay, that's a breakout, boys and girls, on big volume. And kudos to Charlie on the fundamental side, but you have a technical picture that I think is almost better than maybe the fundamentals that we see right now in the whites of our eyes.
So Ben, bring us home. What do you think?
I like the Citigroup thing because I think that the special situation nature of but I will say this, Charlie, you can back me up here. Banks selling banks is never a good sign. I'll repeat that. Banks selling banks is never a good sign. We just saw Schwab and TD. There was a sale there, and we did a deal, was it 2 weeks ago? And now we got Citi selling their bank. And I don't know. I just tell you, we last night talked with David Dredge. We relived the whole 90s, and he was in Asia. And people forget about the 90s. The 90s were insane. It's just that people that only in the U.S. or only in the equity market went up to the right. But the rest of the global markets and the interest rate market, it was the most volatile decade ever. And there's so much that's a parallel to today. And he thinks it's basically like 1996 right now, 97. We're just getting ready for the 97 was the Asian financial crisis. 98, you had long term. There's a lot of stuff brewing here, and you could just feel the tension rising right now. And when you look around, it's just this bull market's tired. Where are you? The AI story's tired. The housing market, which had been strong, is tired. Construction jobs tired. The government, which had been the biggest employer, is now going the other way. I don't know. I have to tell you, there's not a lot I see to be bullish on. Vol's not that vol and credit spreads are low. Valuations are really high. It's just, I would say that I'm pretty bearish. To leave it on that cheery note.
I think Biggs has one more chart, I think. Biggs.
Oh, you do? Okay. I didn't know.
Yeah, we talked about this, but I got to tell you, I don't do macro. This is a bullish chart, and I stand by my prior statements. The resistance is feeble. It's a breakout. And just, how this game works. Everybody and his brother has been genuflecting to Jamie Dimon since that breakdown in 2008 because he lost less money than everybody else, and now he's being canonized. And I just think that you got a bunch of people saying, you know what, I haven't owned Citi in 15 years or more, And I've got to own some now because I can read a chart and the relative strength is better than the rest of them. And I hope maybe I'm the only one that sees it, but I see a room, at least room to 120. And I know that sounds crazy with a bank at 83, $84, but I'm not an economist. I don't play one on TV and I can read a chart.
Okay.
Yes, buddy.
No, I was going to say I actually like that pair trade of short JPM and long City because everyone is full.
Yeah.
Everyone is full JPM.
Yeah, I think because Charlie, we talked about that. I thought like maybe short Wells, long City, or whatever you're basically in that realm. I like the idea of pair trading it much better than the standalone long. And I think that you can use more of the leverage on that. And if you have the near term catalyst, which apparently, as you said, isn't disseminated to the street. So long City, and then there's a variety of different shorts you could short as a bank. As I think that's the superior trade rather than just naked long City, to be honest.
This is, and I am spanning the globe for the constant variety of sport. This is ARC Genomic Revolution. And I know anytime I say ARC, people say it's a sign of the apocalypse. If Kathy Wood stocks are going up, then the world is going to hell in a handbasket. You can think that. I don't care. I'm in this for the money. I shorted Kathy Wood's fund in 22, and it made me up for the year versus everybody else being down. And this is a chart that's just breaking out, and it's very speculative. I'm not going to kid anybody. This isn't mom and apple pie, but it is cutting edge genomic technology companies, either tools or biotechs themselves. And then I look at and I always do this, I go to the fact sheet of the ARKG is the symbol, if I didn't say that already, ARC Genomic Revolution. And the number 10 name is a company that Ben and I have talked about. And I say Ben's pretty smart. He's made money, and both here at Wall Street Beats and elsewhere. And so there's this number 10 name, 4% of the portfolio, Schrodinger, SRDG. And to me, it's very complicated. Ben's smarter than me, and he could go into it if he'd like. But it reminds me a little bit of a PPDI back in the old days. Fred Eshelman started a CRO and started to take pieces of royalties, milestones, eventually equity sales and exits and what have you. And the street hated it because it was opaque, that you couldn't time it, you couldn't model it. And then he spun it out and said, okay, I'll take it. And he sold the whole shooting match to Thermo Scientific and others, and now he owns half of Montana. Schrodinger strikes me as a company that has a software business with a bunch of optionality if they ever have these partnerships turn into big royalty streams. And the trend has clearly changed for ARC, and I would say for Schrodinger's as well. And I bought this at the open yesterday, or in our member chat. I said that, and so far so good.
Yeah, I like it. I bought that at like $20, and I actually sold some of it yesterday because it was like I bought it not that long ago, and I'm going to keep the rest as a convex long. It's an application of AI of hey. I don't know. It's been a while since I've talked about AI in Wall Street Beats, but basically my view is it's as a general intelligence, it's nothing. It's not going to work, but as an application, very specific, like it can be very efficient. And so one of the hopes is that drug discovery is one of those applications, and this company's doing it. Now, just so everyone understands, the pushback on this company is like the Wall Street doesn't like it because they're not that serious about making money. The guy who's the head is a scientist. He focuses on the science, but there's a ton of value. I sent Bakes a report on it that there's a couple different parts of it, and it could be worth $60, $50 pretty easily. But I think if you think about it as an option, so if you size it as an option, this is a stock that can triple, do 2.5 to 3 times. So you think about it like a long dated leap or something like that. And it's good to have some of those in your portfolio. And I'll tell you, yesterday it was up 14%. And I was like, oh, I'm very happy. I have not that big a position, but I was like, oh, this is great. So it's nice to have some of those. And to his point, that ARC-G, I did see somebody else write about that, and it broke the downtrend. And sometimes he could do what Charlie refers to as a prairie dog, right, Charlie? And pops in or pops out and then pops back down. But I like it. And I'm going to say one last thing. I think I put it in the chat yesterday, and I put it on a couple other places to people. We shorted Home Depot last week. So to bow tie this housing thing, it came up on our algorithm. So I wasn't necessarily thinking about, I want to short Home Depot, because again, Home Depot is one of those world-class businesses. They're best in class. And I haven't shorted them since I wrote a 50-page report on them short in May 2006, when I was final part of my grad school before I went to Fidelity. And basically I looked at it deeper, and these guys aren't growing at all. They haven't grown free cash flow in 4 years. There's no earnings growth for the next couple of years. They had huge comps post-COVID. But now if you take what's going on with the housing volumes and the housing market, and now maybe the home builders, because the home builders were active, right? People see no secondary market action for a while, but the home builders have been active. Like, they've been building homes, and they've been the only game in town. And so that's been, Home Depot benefits from that. But if home builders abilities and starts are starting to roll, and the market's a little softer and the economy's a little softer, I looked at these guys. Look, they're trading at the peak, 20-year peak, forward 1, forward 2 PE. Even if you say, like, the street's got them at $15 of earnings, let's just say this thing goes back to 20 times earnings. Still rich, but a little bit, like, it's at 26, 25. A little bit less today because it's down 2%. We shorted at 414 last Thursday or Friday, and now it's at 396. But I think that you could get a 20% haircut here. Now, it's not as exciting as some of the cyclicals, but some of the stuff that you guys have talked about today, some of the building products, some of the home builders, they're already far off their peak. Whereas Home Depot is still near there, and it just put in a head and shoulders chart to bow tie it with my man Bakes, put a little technical on it. It's, I don't know. I'm short Home Depot. I like that. And it's very liquid and asymmetric, and it's in line with what we've talked about today.
Yeah, Ben, I think this is HD's time, and it's not happening in a vacuum. If you look at Whirlpool, if you look at Stanley Black & Decker, if you look at Masco, Mohawk, Beacon Roofing, Builders First Source, any of those names related to home building, they all have rolled. And so now it's Home Depot's time. Kevin probably
Agreed.
give us a better.
Yeah, pull up the chart, Kevin. Let's see what you think.
First of all, this is a bright-eyed, bushy-tailed Ben Bry at the University of Wisconsin writing his short report back here in May in 2006. You can see that was well timed. He was late for basketball practice, but he did okay. Anyway, I don't like this relative strength line hitting new lows, a series of lower highs, and I think we're taking out the low today. And it also comes back to the dynamic we talked about before. My suspicion is that Home Depot, most PMs are pretty full on Home Depot. If you want to have it's big in the S&P and what have you, and I don't see a lot of incremental buyers. And I also like the fact that at the head, okay, 439, here's the shoulder, the left shoulder, and the head, the volume, pretty anemic. That's what you want to see with a head and shoulders top. Here's the right shoulder, and then you see the volume picking up down here, and you see the relative strength line that I mentioned before taking out the low. And I just think that you get a chance here to have some PMs say, yeah, you know what? I don't want to be 3% in HD. I want to be 2%. And sometimes that's enough, where people say they fall on their own weight. And oh, by the way, the growth, you said, the growth numbers are anemic. So unless those perk up, then to heck with this.
Yeah, and look, it's a head and shoulders too. You see the shoulder.
What you're telling us, Bakes, is that Ben Bry is going up for the slam dunk to win the All-Star competition here.
I don't know about that. Yeah. To be fair, shorting Home Depot in 2006 was a slam dunk, because I remember it was like the street had $4.50 in earnings in 2008, maybe $5 in 2009, and I did the math, and I was like, they're going to earn $2, and they ended up earning $2.20 or something, and the stock got cut in half. Half of this story was I was super bearish on housing, and the other half was Robert Nardelli, the guy who got picked over at GE to replace the infamous garbage man Jack Welch, who's a fraudster. I don't want anybody to ever think he was a good CEO. He was a fraudster. And so he basically went to Home Depot and they were stalling out on growth because it was clear in 05, 06 that what was going to happen in the housing market. He started buying HD supply and doing acquisitions. And we all know how that works, paying peak prices to try and like gap earnings. And the street might keep promoting it. But yeah, stock got cut in half. That was a good one. That's the last time I've been short Home Depot. I've been damn near 20 years. Wow. I'm feeling old. Anyway, I think that's it for today. You guys got anything else?
No, we're good.
Nah, I think you've made enough money for people. Let's go. Free diem.
Later, guys. Thank you.
Thanks, guys. Thank you, Jen.
Thanks, Kevin. Thanks, Ben. Thanks, Jeff.
Home Depot lows of the day.